Business environments, businesses operate in an environment that involves the element of risk and uncertainty. This is because the cash flow estimates, including the market demand, revenue, cost, projection, are based on estimates and may be different from the actual. So that is a risk. This is because there are some external factors that may limit the ability of a company to achieve its intended objective. As a result, what you plan to achieve may be different from what you actually achieve. All right. So that is a risk. Therefore, it is important to incorporate the element of risk and uncertainty in the variability in cash flows so that a business or a company is not overly optimistic. In order to avoid being overly optimistic, you need to integrate, you need to incorporate risk and uncertainty in the cash flow estimates. What if it doesn't go this way? What's the worst case scenario? All right. So this is a way of managing risk or of mitigating risk and uncertainty. Generally in finance, risk and uncertainty are used interchangeably. All right. Of course, the two of them are different, but as far as finance is concerned, they are used together. So what do you understand by risk? Risk occurs where future outcome is unknown, but with probability of occurrence and past experience, we can estimate what future outcome will be. So when you are using the past experience and probability to project the future, then that's what is known as risk. Risk also involves the possibility of losing all or part of the original investment. Okay? Then what is uncertainty? Uncertainty is a situation whereby future outcome is unknown and there is no probability or past experience to predict the future outcomes. That is uncertainty. You cannot use past experience or probability to predict the future occurrence. That's uncertainty. So that's different between the two. All right. So that's that. Then what are the methods of mitigating risk and uncertainty? There are basically about 4 or 15 methods that can be used to reduce the risk and uncertainty in cash flow estimate for a project. Our focus will be on 5 key ones, which is expected value method. We talk about expected value method. We are going to talk about standard deviation and coefficient of variation. We talk about simulation. We talk about sensitivity analysis as well as the decision tree. The capital asset pricing model, we have discussed this. This is a topic on its own. All this certainty equivalent method, risk adjusted method, accounting rate of return, discounted paper, all those ones are elementary. You can just go through the material to have the understanding. Now, let's talk about expected value. What do you understand by expected value? The expected value is also known as averaging method or mathematical expectation. It's also known as averaging method or mathematical expectation. It involves averaging the possible outcomes, right? Therefore, when calculating expected value, the most important thing to do is to multiply the probability of occurrence with the possible outcomes. The possible outcomes are the cash flows. Therefore, when you are calculating expected value, you are expected to multiply the probability with the cash flows. All right, we did this under portfolio theory. Okay, now the expected value method is mostly preferred by risk-neutral individual, or manager or decision maker. This is because as a risk-neutral individual, such person or such investor does not seek risk or avoid risk. It's neutral, it's sitting on the fence. So irrespective of the future outcomes arising from the state of nature, the risk-neutral investor or manager will be willing and ready to accept any outcome. Therefore, yes. So the risk-neutral investor will accept any condition, okay, any condition that may arise through the project. All right. So that's basically what expected value is all about. So it is also possible, examiner may want you to calculate expected NPV. Okay, you may be asked to calculate expected net present value. Okay, so the expected net present value is calculated the same way as the normal NPV. The only difference is just that the normal NPV you are familiar with, you are using cash flow to calculate your NPV. But in this one, you are supposed to calculate expected value first. You calculate expected value, then you now use your results to compute the NPV. Whatever you have thereafter represents the expected NPV. So like I said, whenever you're asked to calculate expected NPV, the first thing first, you need to calculate expected value using this formula by multiplying probability with the cash flow. Then for the respective years, once that is done, you can then proceed to calculating the NPV. The result is what is known as expected NPV. There's no big deal in that one. So before we move to standard deviation and then coefficient of variation, let's have illustration that talks about expected value method. Let's have a 30 marks question. Okay. Let's see. Yes, let's solve this illustration number 1. I can't remember the dates. I can't remember clearly. Maybe 2017 or thereabouts. It's a 30 marks question. All right. So let's go through the question together. I need somebody to read for us. Somebody should help us read it. Yes, who's helping us? Quickly.
Okay, good evening, everybody.
Oh,
Lewandowski PLC, a manufacturing company located in the eastern part of the country, designs and manufactures personal stress monitoring device. The device has a commercial life of 3 years. As a result of wide advertisement campaign, the company recorded high sales for the 2 years, while the sales figure for the 3rd year went down substantially due to low demand for the product. The marketing department of the company was assigned the responsibility of finding out the reason for the low demand. The department discovered that the consumers complained of the low quality of the product, which makes it much less durable. With this information, the company decided to submit 200 samples of the devices to the Quality and Assurance Department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed an above average demand. 120 enjoyed average demand, and the remaining 30 enjoyed below average demand. This demand pattern is applicable in all the company's products. Recently, the company developed a new device known as Simple and paid 10 million as development costs. The following projections were made in respect of the product Simple. So we have a table here, year 1 to year 3. Variable costs will amount to 30% of sales. Sales revenue and variable costs will be received and paid respectively on the last day of the year in which they arise. If Simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million payable at the time of purchase. The machine will have a scrap value of 10 million at the end of the product's life. The amount is receivable 1 year after the last year in which production takes place. If purchased, the machine will be installed in an unused part of one of Lewandowski's PLC's factories. The company has been trying to let this unused factory space at a rent of 16 million per annum. Although there seems to be no chance of letting the space in year one, there is a 60% chance of letting it for 2 years at the beginning of year two, and a 50% chance of letting it for 1 year at the beginning of year three, provided it has not been let at the beginning of year two. All rental income will be received annually in advance. Fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million per annum. These costs, which are all specific to the production of simple, and with the exception of depreciation, will be paid on the last day of the year, in which the advertising expenses will be paid on the first day of each year and will amount to 30 million naira at the start of year one, 20 million naira at the start of year two, and 10 million naira at the start of year three. The Wadonsky PLC has a cost of capital of 20%. We are required to analyze and evaluate the production of simple based on expected present value. Show all relevant calculations.
Thank you very much. So that is the question. You can see from the requirements, you are expected to calculate, you are required to calculate expected net present value. So what are you supposed to do in this question? This particular question is very technical in the sense that if you are unable to interpret some of the information given to you in the question, certainly you can't earn your full mark, all right? If you're unable to interpret it, you can never earn your full mark. So quickly, let me stop sharing this and move to the working notes and see how we are going to solve it. Please open to the material at your end so that together we can follow through. Okay, so solution to illustration number 1. Solution to illustration 1, page, I think that's page 78. Page
Yes, it's 78.
Okay, page 78. Now, the name of the company is Lewandowski. Lewandowski PLC. All right. So examiner is now asking you to calculate expected NPV. So you then say calculating expected net present value. So when you ask to calculate expected net present value, the first thing that should cross my mind is that, okay, in this question, I need to, since I'm asked to calculate expected NPV, therefore, I need to first of all go ahead and calculate expected value. So for me to be able to calculate expected value, I need probability. I also need cash flow. In this question, expected cash flow is given to you. You are given sales value. You are given variable cost to be 30% of sales value. All right, but probability is not given to you. How do you then determine? Because there is no way you can calculate expected value if you don't have probability. Because expected value is probability multiplied by cash flow. Cash flow is given to you. There is no probability. But one thing you need to know is that probability is usually attached to state of nature. All right. Probability is usually attached to state of nature. State of nature is the event in the economy. In the economy, you can have good, bad, worse. All right. You can have high, medium, low. You can have optimistic, most likely pessimistic. You can have, like in this case now, in this particular question, we have above average, we have average, we also have below average. Therefore, the examiner has told you in the question that there is a sample of 200 sample of the devices. Therefore, we are told that 120 120 enjoy average or above average demand. Oh, sorry, 50 enjoyed above average demand, 120 enjoyed average demand, and the remaining balance, 30, enjoyed below average demand. So this is the state of nature. So since probability is not given to you, then you use the state of nature to determine your probability. So let's make this first page the main solution. All right. If there's any assumptions you make in the question, you also state your assumption. Let's leave another space for assumption. Then we can start our working from here. Working number one. So we are now given probability. So we determine probability by ourselves. That's one of the things that examiner has hidden in the question. So if you don't know how to determine it, certainly you are going to struggle. You asked to calculate expected NPV, and you know that you are looking for probability and the cash flow. You can see cash flow in the question. You don't see probability. Therefore, if you cannot think outside the box, to know that, okay, probability is usually attached to state of nature. What is the state of nature in this question? Above average, average, below average, and you are given value attached to each state of nature. Then use the value to determine your probability. That's what you need to do. Therefore, I will then come here, above, for the above average. So there are 200 samples. According to the question, you are told that 50, yes, out of the 200 devices, 50 enjoyed above average demand. Therefore, 50 divided by 200, 200 sample. So this will give us 0.25. Okay, that should be 0.25. You also told that we also have average demand. Average demand is 120 divided by the 200 samples, which is equal to 0.60. We're also told that the balance of 30, we are told that 30 enjoyed below average demand, below average. Then this will be equal to 30 divided by 200 samples. This will give us 0.15. You add everything together, that will give you 1. At all time, your probability must be equal to 1. So this is how to determine the probability for the question. Okay, this is how to determine the probability. Now that you have the probability, we can then proceed to calculate expected sales. Okay, calculate expected sales. Working number 2. Let me see. Let me move to the next page. Expected sales. Okay. How do you determine the expected sales? Of course, to get the expected sales, all you need to do is to multiply probability with the sales value to get the expected sales for each year. So in this question, we have 3 years. Therefore, you create a column for state of nature. All right, create a column for state of nature. Before that, you divide this one into 3. We have year 1, year 2. We also have year 3. Okay. Therefore, you create a column for states of nature. Under the state of nature, we have above, average, then we have below, demand. All right. Also, You also divide this one. Sorry. So you create a column for probability. You create a column for probability. All right. Then you divide this one into 2 each. Okay. Divide this one into 2. All right. So close this, close this, close this. This is total. Probability for above is 0.25, 0.60, 0.15. I will then go back to the question. What's the cash flow for year 1? Give it to me, please. Cash flow for year 1.
240. 140.
140.
50.
50. Then cash flow for year 2.
500. 340.
And then
180.
180. Year 3.
160. 80.
And then
50.
50. So those are the cash flow given to us for the respective years. So to now get the expected sales value, the expected value. So you create another column for this, which is expected sales value, expected sales value, expected sales value. So to get the expected sales value, you know that that's your X bar. And you know that X bar is equal to summation of probability of X. That is, you are supposed to multiply probability with the cash flow. Therefore, for year 1, 0.25 multiplied by 240, what you get?
60.
60. 0.6 multiplied by 140.
84.
84. 0.15 multiplied by 50.
7.5.
7.5.
7.5. Add it up. That's 1.
151.5.
151.5. Remember, figures are in millions. Okay? Figures are in millions. Then for year 2, you multiply 0.25 by 500. What you get?
125.
125. 0.6 multiplied by 340.
204.
204. 0.15 multiplied by 180.
27.
27. Add it up. That's 3, 5,
356.
6. 356. That's expected sales for year 2. Then year 3, 0.25 multiplied by 160.
40.
40. 0.6 multiplied by 80.
48.
48.
48. Add it up. That's 95.5. Am I correct? So now
Yes.
that, yes, so now that you have the expected sales value, so you have a choice. You can either, as you have calculated the expected sales, you go and post this. Then you now calculate your variable cost. According to the question, you are told that variable costs will amount to 30% of sales value. So what that means is that all the sales value you have computed, the 151.5, the 356, the 95.5, you multiply 30% on it to get the variable cost. Or you know that contribution is sales minus variable cost. So instead of you to have a line item for sales value, another line item for variable cost, why don't you just calculate contribution? Therefore, I will then determine my contribution. Contribution is 70% of the sales value. All right. So I would then say working number 2. Oh, okay.
3.
Okay, working number 3. I will have to, let me see. So this is where the system stopped. Now, according to the question, the useful life of this project is for 3 years, I think. Let me confirm that again. Yes, 3 years, year 1 to 3. However, you are told that advertisement is paid in advance. So we create a column for year 0, year 1, year 2, year 3. Then, of course, let me go back to the question and confirm. I think you are told that the scrap value will be received in the 4th year. You are told in the question that the scrap value of 10 million naira, the amount is receivable 1 year after the last year in which production takes place. So, meaning that the final year is year 3. So, because of that, since the scrap value is not received in the final year until the 1 year after, so this will extend by additional 1 year. Then we are going to have column for workings. So, like I said, in the question, you are given variable cost to be 30%. It means that contribution will be 70%. So instead of me to have a line item for sales value, another line item for variable cost, why don't you just calculate contribution straight? All right. So I will then come here, contribution. So let's go and do workings for contribution. Again, on the day of your exam, you may not do working for this. You already know that contribution is 30%. Just multiply 30% on the sales value you have calculated. All right, but let's work it out. Working number 3, contribution at 70%
70%.
of sales. So you do it year by year. For year 1, year, then working, contribution. Okay. For year 1, year 2, year 3. Okay. So in year 1, the sales value, the expected sales in year 1 is 151 million, 151.5 multiplied by 70%. Year 2, 356 multiplied by 70%. 95.5 multiplied by 70%. So what do you have? Give it to me. For year 1, what do you have there?
106.05.
106.05 million. Then the next one. Yeah.
249.2.
249.2. Next one.
66.85.
66.85. So that represents the annual contribution. Let's go and post it. 106.05. So year 1 is 106.05. Year 2 is what? Year 2 is 249.2. Year 2, 249.2. 249.2. Then 66.85. I think this
Yes,
working
sir.
number 3. Then after contribution, you go back to the question. What are the other cash flows? What are the other relevant cash flows you need to consider? So according to the question, when you look at paragraph number 3, you are told in the question that recently the company developed a new device known as Simple and paid 1 million naira as development cost. Development cost is an example of sunk cost. Therefore, that 10 million naira is irrelevant. You ignore it. It's not relevant. It should be ignored. Then move on. So you don't need to consider variable cost again since you have calculated contribution. Next item will then be, you are now told further that if Simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million naira. That's initial outlay. When we get there, we are going to use it. The machine will have a scrap value of 10 million naira, okay, at the end of the product life. The amount is receivable 1 year after. So when we get there, we also account for that. Next item, you are now told that if purchased, that is, if this machine is purchased, it will be installed in an unused part of Lewandowski PLC factories. The company has been trying to let the unused factory space at a rent of 16 million naira per annum. Okay, nothing to do in that one.
It's
You are not told
irrelevant.
that although there seems to be no chance of letting the space in year 1, there's a 60% chance. Chance is the same thing as probability. Okay, there's a 60% chance of letting it for 2 years at the beginning of year 2. In this particular paragraph, this is what the examiner has hidden in the question, because if you are unable to interpret this paragraph correctly, then of course that means you cannot get the answer correctly. So you are told that although there seems to be no chance of letting the space in year 1, there is a 60% chance of letting it for 2 years at the beginning of year 2. Please pay attention. Beginning of a year. Beginning of year 2 means end of year 1, because before you can recognize a year, you have to count 12 months, January to December. So if you are told that beginning of year 2 simply means end of year 1. Beginning of year 3 means end of year 2. Beginning of year 4 means end of year 3. Beginning of year 1 means year 0. All right, so you need to understand that because you have to count 12 months before you can recognize a year. So if that is the case, you are told in this particular paragraph that there's a 60% chance of letting it for 2 years at the beginning of year 2. Beginning of year 2 means end of year 1. So you are letting it out for 2 years. That means at the end of year 1, you are going to account for 60% of 16 million naira for 2 years in advance. So whatever that is, you account for year 1, you also account for year 2. So let's quickly go and do working for that because of time. Working number 4. This is called opportunity cost, because the company will not be able to receive the rent as a result of, because you are going to use the space to install this file, to install this machine. So you cannot earn, the company will not be able to earn the rental income. So that's an opportunity cost on rent. All right. So let's calculate the opportunity cost for year 1, year 2, and then year 3. So I'll put workings for here. Then I also have probability here. Okay. Now, you are told that there's a 60% chance of letting it for 2 years at the beginning of year 2. So 60% multiplied by 16 million. What do you have there, please? What's 60% of 16 million? That's
9.6.
9.6 for 2 years. So 9.6, another 9.6 dash. So you are letting it out for 60, you are letting out 60% for 2 years at the beginning of year 2. Beginning of year 2 is year 1. So at the end of year 1, you have let it out for 2 years. So that's the interpretation. Then probability is 0.60. You know that probability must be equal to 1. So out of 1, 60% is gone. We are left with 40%. So examiner now told you that, and a 50% chance of letting it out for 1 year at the beginning of year 3, provided it has not been let at the beginning of year 2. This 50% has not been let out at the beginning of year 2. So that one is out of it. But you are told that beginning of year 3. Beginning of year 3 means end of year 2. Therefore, and you know that if you cannot multiply 50% of the 16 million, because if you account for 60%, it will be more than the probability of 100%. Yeah. Therefore, what the examiner wants you to do is to take 50% of the balance of 40%. All right. So take 50% of the balance of 40%. So that will give you 0.2. All right. That will give you 0.2. You then multiply this one by the 16 million. So what do you have there, please? What do you have?
8.2.
8.2. Remember that this 8.2 is not meant for year 1.
Please. 3.2.
Okay, so that 3.2 is meant for year 2 because you are told that beginning of year 3 for 1 year. Beginning of year 3 is end of year 2. Here will be 3.2 dash. All right. So as it is now, that is this. Then I read further from the paragraph. All rental income will be received annually in advance, okay? Fixed costs, so that one is a different thing. So let's go and conclude this. Now, when you look at our calculation for the opportunity cost, you will notice that probability is not equal to 1 because this is just 80%. This is just 80%. 0.6 plus 0.2, that's 80. So probability is not equal to. Now, the balance of the 50%, you then say 50% multiplied by 40%. This will give you 0.2 just to make the probability equal to 1. So there is no special thing on that one. All these ones are dash, nothing to put there. So total, here will be 9.6, here will be 12.8. That's it. That's the opportunity cost. Then you go and post it. 9.6, then 12.8. So you come here, say opportunity cost. Year 1 is 9.6. So cash outflow, 12.8. Cash outflow, dash. Working number, is it 4? Let me see. I think so. Yes, that's working number 4. So let's go back to the question. What's the next item? After the rental income, the next item is, yes, you are now told that fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million naira per annum. So this 70 million naira is not relevant because it includes depreciation. You know, I explained to you when we had capital budgeting that there are 3 ways examiner can test fixed cost. If you are given fixed cost, no additional information, that fixed cost is irrelevant. 2, if you are given a fixed cost, including depreciation, that fixed cost is also not relevant, but you need to calculate annual depreciation, then you less from the fixed cost. Whatever you have thereafter is relevant. Then 3, you may be given fixed cost excluding depreciation. So when you are given a fixed cost that excludes depreciation, the fixed cost is relevant. You need to account for it. So in this case, let's go and do our working. This 70 million is not relevant. So we need to calculate annual depreciation, then you less from the fixed cost. That's working number 5. Specific fixed cost. Okay. Figures in million. So the fixed cost given to us in the question is 70 million. And we said that 70 million is irrelevant because it includes depreciation. Therefore, we calculate annual depreciation. And you know that depreciation is the cost minus scrap value divided by the useful life, which is equal to the cost of the machine is 190 million minus scrap value of 10 million divided by useful life of 3 years. Therefore, what do you have? 180 divided by 3, that's 60 million. Annual depreciation is 60 million. Therefore, the specific fixed cost is 10 million. That's the specific fixed cost. So let's go and post it. There's no inflation. So 10 million per annum. Specific fixed cost. 10 million each. 10 million. Please don't go and do mistake and add 10 million to year 4. Year 4 is not, the useful life of the project is 3 years. Year 4 is just for because of scrap value that is extended to the 4th year. Move on from here. Immediately after the fixed cost, you are now told further that there is an advertising in the following paragraph. You are told that advertising expenses will be paid on the 1st day of each year. 1st day of each year, meaning that at the beginning of each year, and we amount to 30 million naira at the start of year 1, 20 million at the start of year 2, and 10 million at the start of year 3. So let's account for advertising expenses. Adverts. Expenses. So beginning of year 1 means year 0. Beginning of year 1 means year 0, which is 30 million. Advertising expenses of beginning of year 2 means end of year 1, which is 20 million. Beginning of year 3 means end of year 2, which is 10 million. That's that. Then what else? So because there is no taxation in this question, we don't need to worry ourselves. So the next thing we need to do is to just account for scrap value. Scrap value. So we're now told that there's a scrap value of 10 million naira, and this 10 million naira will not be received until the fourth year. So here is 10 million naira. What else? Let's go back to the question. Yes, I think that's it. That's it. So let's calculate the net cash flow. Lastly, we need to include the initial outlay.
So did you want the scrap value? Which paragraph is it? I'm mixing it up.
That's paragraph 4.
Okay. Paragraph where they say if simple is produced, the machine will have scrap value of 10 million at the end of the product's life.
Yes.
End of product life, that is end of year 3.
Yes, and the product life is 3 years. So end of year 3, you are not told that where is it? Where is the information again on
Just
the
under that table, under the sales revenue table, the second paragraph.
Yes. So that's it. Yes, you are told that the machine will have a scrap value of 10 million naira at the end of the product life. End of product life is year 3. The amount is receivable 1 year after. So that's why
Okay.
we extended it to year 4.
Okay. Mm.
So let's get the net cash flow. So initial outlay is 190 million. Okay. So let's get the net cash flow. Here will be 220. Here will be 10. Here will be 56.85. Only me have done 3. Oh. Yes.
Mhm.
So this is net cash flow.
You did
What
the
do you
easy
have?
ones.
Well, after all, I've answered 3 out of how many? So we have year 1 and 2. What do you have? Give it to me, please.
Year 2 is 216.4.
Year what?
Year 2,
Uh-huh.
216.4.
216.4. Okay.
Year 1, 66.45.
66.45. Okay. 66.45. All right. So we didn't need to discount this. Discount factor. The cost of capital given in the question is
10.
is it 10%?
20.
20%. Cost of capital is 20%. Therefore, give me discount factor for year 1 at 20%.
0.8333.
0.833. Year 2,
0.694.
694. Year 3,
0.5787.
0.579.
9.
Year 4,
0.482.
482. This will be 4.82. Yes, this will be 220. Give it to me, multiply.
55.35. Year 1.
55.35.
Year 3, 32.916.
32.92.
0.92.
Year 2, 150.18.
150.18. Then to get the NPV, to get the expected NPV, you need to add up all the positive present value minus the negative to get the expected NPV. What's your final answer?
Positive 23.27.
23.27.
27.
So that's that. I would then say the expected NPV, the expected NPV is, let me write that, 23,270,000 naira. Okay, so that's that. Then you can advise that the project should be accepted. Okay, therefore, the project is financially, let me write it. What's wrong with you? Financially viable and should be Accepted. That's it. So this question is 30 marks. You will never earn your 30 marks if you don't state your assumptions. So you need to state your assumption with your calculation. You don't come here. Assumption. You can see examiner did not ask you to state your assumption, but it's implied in the question. You will never earn your full mark if you don't state your assumption. So you just have to say the calculation above is based on the following. Let me write that. On the following underlying assumptions. So what assumptions have you made in the question? I've already told you previously that whenever you want to state your assumption, you have to talk about cash flow. All right, talk about cash flow. Our assumption here is that under cash flow, it states that it is assumed that the cash flow estimates will occur at the end, the cash flow estimates are realistic and will occur at the end of each year. Then 2, you talk about development costs, talk about sunk costs. We have a sunk cost of 10 million naira, which is development cost. So you are then going to say the development cost of 10 million naira is a sunk cost and therefore not relevant to this calculation. Number 3, you are given cost of capital. So you talk about cost of capital as well. You are given cost of capital of 20%. Then you say it is assumed that the cost of capital of 20% is appropriate and consistent with the cash flow. So any other assumptions that you have made in the question, you can also talk about scrap value. Number 4, we have a scrap value of 10 million naira. Okay, so it is assumed that the scrap value of 10 million naira is realistic because if the company could not dispose of the machine at that price, the decision to accept the project may change. Therefore, at this point, you can decide to calculate the sensitivity margin of scrap value to see the extent to which the project NPV can accommodate the change in the scrap value. All right. So any other assumption that you have made in the question, you need to talk about it. Then, not only that, we also talk about depreciation. Okay. We also talk about depreciation, number 5. There is a depreciation of 60 million. So what do you mean by depreciation? You say that the depreciation of 60 million naira, the annual depreciation of 60 million naira is a non-cash item, therefore not relevant to this calculation. So these are some of the assumptions that you have made in the question that you need to talk about them each. Okay, I think that's it. If you like, you can also comment on the advertising expenses, but that one is not important. So that's end of the question. That's end of the question. So at this point, let's move on. Let's move on to the next one. So let me stop sharing this and move to the notes. Okay. Let's go back. Now let's talk about standard deviation. Okay, let's talk about standard deviation. Standard deviation represents the statistical measure of absolute dispersion and is a measure of spread about mean value. Okay, standard deviation represents a statistical measure of absolute dispersion and is a measure of spread about mean value. Standard deviation measures the risk inherent in a project, and the higher the standard deviation, the more risky the project. So how do you then calculate standard deviation? When you want to measure the risk inherent in a project, the risk associated with a project, you use standard deviation or coefficient of variation. However, using standard deviation, how do you compute it? This is the formula for calculating standard deviation. It's simply the square root of variance. Okay? standard deviation is the square root of variance. And you know, square root of, variance is summation of probability of x minus x bar square. We did this under portfolio theory. All right, so that's that. Now, you may also be asked to calculate standard deviation of expected NPV. You may be asked to compose standard deviation of expected NPV. So the standard deviation of expected NPV can be calculated as follows, depending on whether there is mutually dependent cash flow or independent cash flow. All right, so what do you mean by mutually dependent cash flow? The mutually dependent cash flow, let me put it down. It's not in your notes. Mutually dependent cash flow are cash flows in which the events in each year, are the same. So that's what is known as mutually dependent cash flow. Now, on the day of your exam, once you notice that the cash flow of year 1 is the same thing as cash flow of year 2, the same thing as cash flow of year 3, on and on like that, then it means they are mutually dependent cash flow. So if it's a mutually dependent cash flow, then the standard deviation of expected NPV will then be computed as standard deviation multiplied by annuity factor. Okay, standard deviation multiplied by annuity factor. So that's how to calculate standard deviation of NPV, or standard deviation divided by 1 plus r raised to power n. So this one will take you a long time to solve. Just go ahead, calculate annuity factor, because 1 plus r, this will be the discount factor for year 1. You calculate discount factor for year 2, discount factor for year 3, continue to do like that. So, but since you know that the standard deviation is constant, therefore just calculate annuity factor, multiply with the standard deviation, and you are good to go. All right. Then the second one, where there is independent cash flow. What do you mean by independent cash flow? Independent cash flow, okay, independent cash flow is a standalone cash flow in which the events in each year is the same. Sorry, is different. The event in each year is different. Okay, that's independent cash flow. All right. So once you are given a question and you notice that cash flow in year 1 is different from cash flow in year 2 is different from cash flow of year 3, then you should know that it's a standalone cash flow. So where you are given a standalone cash flow, then the standard deviation of expected NPV will be computed as the variance in each year divided by 1 plus r raised to power 2t. Then you find the square root. All right. So that's the formula for calculating standard deviation of NPV, where there is independent cash flow. All right. So let's talk about coefficient of variation before we solve questions. All right. So what do you mean by coefficient of variation? The coefficient of variation is a statistical measure of relative dispersion and is a measure of spread about mean value. Coefficient of variation measures the risk associated with a project, and the higher the coefficient of variation, the more risky the project will become. However, where 2 or more projects with varying sizes are being considered, standard deviation may not produce optimal solution. Therefore, A more relative measure of dispersion should then be used. That is, you use coefficient of variation in that regard. Hence, how do you compute coefficient of variation? So the formula you are going to use to compute coefficient of variation will depend on your standard deviation and expected value you have computed. If you have computed standard deviation using this formula, which is summation of probability of x minus x bar squared. So you have computed standard deviation using this formula. You also calculate expected value using this formula, probability of x. All right. Then in this case, the coefficient of variation will then be calculated as standard deviation divided by expected value. Okay. But if you have computed expected NPV, you also compute standard deviation of expected NPV. You are now asked to compute coefficient of variation. So in this case, coefficient of variation will then be calculated as standard deviation of expected NPV over expected NPV. So that's that. Those are the formulas that you can use to compute the coefficient of variation. Okay? So, yes, at this point, let's have illustration to demonstrate the two, where you have mutually dependent as well as an independent cash flow. Let's check. Let's have examples of that. Okay. Yes, let's solve illustration number 4. Let's solve illustration number 4. This represents independent cash flow because the cash flow in year 1, year 2, year 3 are all different. So this is independent cash flow. Oh yeah, somebody should help us to read. Who is reading for us? Yes, who is helping us? Okay, let me read then. Barcelona Limited has an investment proposal that has the following probability distribution of returns. All figures are assumed to be correct. Then the events of each year are independent of other years. Okay. The outlay on the project is fixed at 22,000. That's the initial outlay. And the appropriate cost of capital is 10%. Okay. Required, calculate 1, the expected net present value. 2, the variance of return in each year. 3, the standard deviation of the net present value. 4, the coefficient of variation. That is the question. You want to calculate expected NPV. First thing first, you need to calculate expected value for each year. Let me stop sharing this and move to the working note straight. So I want to calculate expected value. This is solution to illustration. What illustration is that? Let me confirm. Illustration number 4, page 79. Solution to illustration number 4, page 79. All right, Barcelona Limited. So number 1 requirement, you have to calculate expected NPV. You cannot get expected NPV without first of all calculating expected value. The second one, you have to calculate variance. So I will match the two together. I will then say calculating expected value and variance. So you do it for each year. For year 1, okay. So create equivalent for probability. Create a column for cash flow. Another one for expected value. Then you are going to have cash flow minus expected value. Cash flow minus expected value square. Then probability of cash flow minus expected value square. All right. Therefore, of course, this is P probability, this is cash flow X. Now, give me the probability for year one, please, quickly.
0.2,
Uh-huh,
0.4,
uh-huh.
0.4.
Okay. So please don't forget, at all time, your probability must be equal to 1. If it is not equal to 1, you have to make it equal to 1. Then, for the cash flow, give me cash flow for year one.
6,000,
Uh-huh.
8,000,
And then
9,000.
9,000. So to now get the expected value, you are expected to multiply probability with the cash flow. 0.2 multiplied by 6,000 will give us 1, 2. 0.4 multiplied by 8,000, 3, 2. 0.4 multiplied by 9,000 will give us 3, 6. When you add it up, that's 8,000. So expected value for year one is 8,000. Now, to now get the variance, we have expanded the formula. Therefore, 6,000 minus 8,000 is minus 2,000. Minus 2,000 squared is 4 million. 4 million multiplied by 0.2, you give us 800. Okay, 800,000. Then, next one, 8,000 minus 8,000 will give us 0. 9,000 minus 8,000 will give us 1,000. 1,000 squared is 1 million. 1 million multiplied by probability of 0.4, 400,000. So that's 1,200,000. That's the variance for year one. I will also do for year two. Probability, cash flow, expected value, x minus x bar, x minus x bar square, then probability of x minus x bar square. In year two, give me the probability, please.
0.5, 0.5.
0.5. Give me the cash flow.
8,000,
Uh-huh.
1.2, 1.2.
12,000.
Okay.
Okay. So 50% of 8,000 is 4,000. 50% of 12,000 is 6,000. Therefore, expected value for year two is 10,000 naira. 10,000. Okay. Now, to get the variance, 8,000 minus 10,000 will give us minus 2,000. Minus 2,000 square will give us 4 million. 4 million multiplied by 0.5 will give us 2 million. 12,000 minus 10,000 will give us 2,000. 2,000 squared is 4 million. Multiplied by probability of 0.5, 2 million. You add it up, that will give 4 million. That's the variance for year two. I will then do for year three. Probability, cash flow, expected value, x minus x bar, x minus x bar squared, then probability of x minus x bar squared. So give me the probability for year three, please.
0.3,
Uh-huh.
0.5,
And then
0.2.
0.2, which is 1. Cash flow, please.
7,000,
Uh-huh.
11,000,
And then
17,000.
17,000. So to get the expected value, You multiply. This is 2155. Okay, then 34. When you add it up, that will give us 11,000. Expected value for year 3 is 11,000. So to get the variance for year 3, 7,000 minus 11,000 will give us minus 4,000. Minus 4,000 squared will give us 16 million. 16 million multiplied by probability of 0.3 will give us 4,800,000. 11,000 minus 11,000, 0. 17,000 minus 11,000, 6,000. 6,000 squared, 36 million. 36 million multiplied by probability of 0.2, 7.2 million. You add it up. This will produce 12 million. That's the variance for year 3. Now you have computed
So the first one is 4,900.
Which one?
Year 3, first, x minus x bar.
X minus, how is it 3,900? 7,000 minus 11,000, that's 4,000.
Okay.
Yeah. So now that you have computed expected value, you can then answer the question. Requirement number 1. So calculating expected NPV. Calculating expected net present value. So to calculate expected NPV, you are going to use the expected value computed to compute your NPV. So create a column for year. Description of items. You have cash flow. Discount factor. What's the cost of capital given?
10.
10%. Okay. So year 0, year 1, 2, 3. There's no scrap value in the question. So here we have initial outlay. Initial outlay of this question is how much? How much is initial outlay?
22.
22,000.
22,000. So here is 22,000 multiplied by 1, 22,000. Okay. Then the expected value we've computed for each year. Year 1, we calculated 8,000, 10,000 for year 2, then 11,000 for year 3. Here will be 9.909, 0.826, 0.751. This will give me, multiply for me, please. This is 8260. I think 7272. Here will be 8261. So the NPV, the expected NPV will then be equal to, what do you have? 179, then 3. Please confirm. Is it 1793, correct? I think so. Let's move on. Then number 2, you have to calculate variance. So year, then variance. We've already done that. Variance for year 1 is 1.2 million. Year 1, year 2, year 3, 1,200,000. Variance for year 2 is 4 million. We calculated variance of 12 million for year 3. Okay. So number 3 requirements. you have to calculate standard deviation. So I would then say standard deviation of NPV. Before I put down my formula, I need to go back to the question and confirm the nature of the cash flow. According to the question, the cash flow is independent. Even the examiner told us in the question that the events of each year are independent of other years. So that means we have independent cash flow. Since there's independent cash flow, then the standard deviation of NPV, the standard deviation of expected NPV will be computed as variance in each year divided by 1 plus R raised to power 2t. Find the square root. Okay, so I would then say standard deviation of expected NPV equal to variance of year 1 is 1.2 million divided by discount factor of year 1, 1.1. Cost of capital is 10%, therefore 1.1 raised to power 2 times year 1 plus variance of year 2, which is 4 million divided by 1.1 raised to power 2 times year 2 plus variance of year 3 of 12 million divided by 1.1 raised to power 2 times year 3. Then you find the square root. Okay, so keep on expanding it. Standard deviation of NPV will then be equal to 1,200,000 divided by 1.1 raised to power 2 will give us 1.21 plus 4 million divided by 1.1 raised to power 4 will give us 1.4641 plus 12 million divided by 1.1 raised to power 6 will give us 1.771561. Then you find the square root. Okay. Then the standard deviation of NPV. At this point, there's no need for you to be doing it one by one. It's a waste of time. So you bring out your calculator. Bring out your calculator. You then open a bracket from your calculator. 1.2 million divided by 1.21. Close the brackets. Plus, open another bracket. 4 million. 4 million divided by 1.4641. Close the brackets. Plus, open another bracket. 12 million divided by 1.771561. Close the brackets. Then press equal to. That's 10,497,476.519 and all of that. So whatever you have in your calculator, just press square root. So that'll give us 3239.98. That's approximately is 3240. That's it. That represents the standard deviation of NPV. So number 4, you have to calculate coefficient of variation. Coefficient of variation, CV. So in this case, because we have calculated standard deviation of NPV, we also compute the expected NPV. Therefore, coefficient of variation will be computed as standard deviation of NPV divided by expected NPV. which is equal to 3240 divided by 1793. This will give us 1.81. That's it. You can see it's not difficult. Just master the formulas and you are good to go. So let me know if you have any question for me. If not, let's have additional illustration. All right, let's have additional illustration. So let's have a question that involves mutually dependent cash flow so that you see how to treat it. I will stop sharing this. Okay, let's solve this illustration number 5. Tonkpolo Limited. Who is helping us to read, please? Do I still have women in this class? Who is helping us?
Okay, let me try.
Okay.
I'm a bit on that question. So,
Oh, well, go ahead.
Tombolo Limited is considering whether to invest in a project which would entail immediate capital expenditure on equipment worth 40,000 naira. The expected sales volume from the project are given below. So, table below, all figures are assumed to be correct. The unit selling price is 15 naira. Variable cost per unit is 9 naira. Once sales are established at a certain volume in the first year, they will continue at the same volume in the subsequent years. The useful life of the project is 6 years, and the equipment will be sold for 5,000 naira at the end of the project. The company's cost of capital is 10%. You are required to calculate 1. The expected net present value of the project, 2. Standard deviation of NPV, and 3. The coefficient of variation.
Thank you very much. Yes, that is the question. So you are required to calculate expected NPV. So as usual, we need to calculate expected value first before you can calculate the expected NPV. But one thing is in this question, you are not given cash flow. All right. You are given probability. You are not given the underlying cash flows. So what that means is that first thing first, you need to calculate cash flow. How do you then determine the cash flow? You are given selling price to be 15 naira. You have variable cost of 9 naira. Therefore, contribution per unit will be 9 naira. Will be 6 naira. Once you have contribution per unit, you then multiply with the number of units, the sales volume, so to get the cash flow. Once you have your cash flow, you then calculate expected value by multiplying the probability with the cash flows. Once you have your expected value, you proceed to calculating the expected NPV. It's as simple as that. So let me stop sharing this and move to the working notes. Okay. Let me start. Okay. Solution. So illustration number 5. I think it's illustration number 5. Page 88. Let me confirm that. 88. Illustration 5.
Page 80.
Page 80. Yes, thank you. Page 80 is there. Okay. So first thing first, you calculate cash flow. I would then say, let me start with working. Number 1, I want to calculate cash flow. Sorry, contribution. So contribution equal to selling price minus variable cost per unit. So selling price is 15 naira. Variable cost is 9 naira. Therefore, contribution per unit is 6 naira. Now that I have contribution per unit, I need to get total contribution. So, to get this total contribution, I'm given sales volume. Then I will create a column for contribution per unit. Then total contribution. Okay. So give me the sales volume, please. What's the sales volume? Are we still together or am I on my own?
2,000.
2,000. The first one is 2,000.
1,000.
1,008.
1,008. 1,500.
2,500.
1,000.
2,500, then 1,000. So contribution per unit is 6 naira. Multiply 12,000. 1,800 multiplied by 6, that should be 10,800, I think. 1,500 multiplied by 6, 9,000. 2,500 multiplied by 6, 15,000. Then 1,000 multiplied by 6, 6,000. So that represents the cash flow. Now that you have the cash flow, you can then proceed to calculating expected value. So number 2, calculating expected value. So I will merge it with variance. So you can see examiner has told you in the question that once sales volume is established at a certain level, they will continue at that level going forward. So what that means is that they are mutually dependent. So the cash flows are mutually dependent. All this cash flow that we have computed is for year 1, year 2, year 3, up to year 6. It's the same thing. So in that case, they are mutually dependent. Therefore, I will create a column for probability, cash flow, expected value. Then to get the variance, cash flow minus expected value, cash flow minus expected value square, then probability of cash flow minus expected value square. Okay. So probability, give it to me. What are the probability? 0.15.
0.20.
0.20. Next.
0.35. 2.10.
10, and then
0.20.
0.20. Again, please, at all time, your probability must always be equal to 1. Then we have cash flow of 6,000 for the last one, followed by 15,000. Want to push it up. 9,000.
10,800.
10,800, and then 12,000. So to now get the expected value, what's 15% of 12,000? Yeah,
1,800.
1,800. 35% of 9,000 is what?
3,150.
3,150. Add it up. This should be 9,810. That's the expected value. Therefore, to now get the variance, I'm going to multiply, I'm going to deduct. You deduct 12,000 minus 9,810. What you get?
2,190.
2,190. 2,190 square. What do you have there? Yep.
4,796,100.
4,796,100 multiplied by probability of 0.15.
7,000. Sorry.
Yep.
719 415
415.
5
Okay. Next one. 10,800 minus 9,810.
990
980 square. 980,
980 100
980, 100. Multiply by 0.2.
196020
196,020. Next one. 9,000 minus 9,810 minus 810. Minus 810 square is what?
656 100
656, 100. Multiply by 0.3 probability.
229 635
229,635. Then the next one, 15,000 minus 9,810.
5190
5190 square.
269
269. 3 what?
36 100
100. Multiply by 0.1. That will be 2,693,610. 610. Then the last one, 6,000 minus 9,810 will give us minus 3,810. Minus 3,810 square is what?
145
14 million.
16 100
16. Okay, hold on.
516 100
516. Let me do it again. 516, 100. Multiply by 0.2. 2 million.
2903 220.
Okay, 220. Add it up. That will give us variance for the projects. What's the total variance? Yes.
674 1900
6741900. Okay. So that's the variance for the projects. Then we can then answer the question. Requirement number 1. You have to calculate expected NPV. So calculating expected net present value. Okay. So create a column for year. Items. Cash flow. Discount factor. What's the cost of capital given?
10%.
10%. Year 0. The initial outlay is what?
40,000.
40,000 multiplied by 1, 40,000. Then, of course, the useful life of the project is 6 years. So since they are mutually dependent, then year 1 to 6, cash flow. The total expected value is 9810. So somebody should give me an annuity factor of year 1 to 6 at 10%. We also have scrap value in the question. How much is scrap value?
5,000.
5,000. So give me annuity factor, year 1 to 6 at 10%.
4.355.
4.355. Discount factor for year 6 at 10%, 0.5,
0.56447. 0.5645.
so 0.564, 3 decimal place. Then give me the present value, please.
2825.
28.
Year
This is
6.
year 6, 2825.
One to 6. 42722.55.
426. 426 what?
42722.55.
42722 or 23. 42723. What's the final answer?
5547.55.
There is no point there.
Five, five,
Five,
So,
four,
what?
5548.
5548.
448. So are you sure this number two, the present value of year 1 to 6 is correct as 42723? 9, 8, 10.
Let me reconfirm it.
Yes, it's correct.
Okay then. So that's
Yes,
that.
correct.
So examiner wants you to calculate the expected NPV, and that's what we have done. Calculate the expected NPV of the project. Then 2, calculate standard deviation of NPV. I would then say number 2, standard deviation of NPV. Okay. So because the cash flow are mutually dependent, so in this case, standard deviation of expected NPV will be computed as the standard deviation multiplied by annuity factor. So in this case, I need to calculate the standard deviation. To get the standard deviation, I will get the square root of variance. Okay, which is equal to square root variance. We calculated variance to be 6,741,900. 6,741,900. So what do you have there? Our standard deviation. Yes.
2596.5.
2597. Then annuity factor. We've calculated annuity factor to be 4.355. Therefore, the standard deviation of expected NPV will then be equal to 2597 multiplied by 4.355. This is what? 11,310. Please confirm.
310.
All right then. So that's the standard deviation of the NPV. Then lastly, number 3, you have to calculate coefficient of variation. Coefficient of variation, CV. Okay, so CV equal to standard deviation of NPV over expected NPV, which is equal to 11,310 divided by the expected NPV is 5543. I think, let me confirm, 5548. So this will give 2.04. Please confirm. Is it correct? 2.04?
Yes.
Okay then. So that's end of the question. That's end of the question. So let's use the remaining minutes to explain sensitivity analysis. All right. Now, let me just use this material and let's continue from here. Sensitivity analysis. Okay. So give me 1 minute. So what do you understand by sensitivity analysis? The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. I said this measures, okay, let me just use the, let me see. Let me check the material if I have all the relevant formulas there for calculating sensitivity margin. Otherwise, I'll just use the working notes to explain it. Sensitivity, okay. Okay, let me stop sharing. Let's use the material so that I don't need to be writing this to waste time. Okay. I believe you are seeing I'm sharing the note, the study material, right? Or are you seeing the working notes?
It's the working note.
Wow. I thought I was sharing the material. Okay. So, like I said, the sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variables. For this purpose, variables include cost of capital, initial outlay, sales value, sales volume, variable cost, contribution, savings, okay, specific attributable incremental fixed costs, and then project life. These are variables. You want to know what is the percentage of change in variables before the project will become unviable. What if initial outlay increased by 5%? Will the project still be viable? If the sales volume reduced by 10%, can the project still be viable? That is what sensitivity analysis measures. The tolerable extent to which a project NPV can accommodate any change in variable. If you increase your sales value, if you reduce your sales value, will the project still be viable? If you increase your variable cost, can the project still be viable? That is what sensitivity analysis measures. Now, how do you then calculate sensitivity margin? There are 3 different formulas that can be used to compute sensitivity margin depending on the variable. For all the variables, excluding project life and then cost of capital, sensitivity margin will be calculated as NPV divided by the present value of the variable. Okay. Then the second formula is sensitivity margin to cost of capital. which is computed as internal rate of return minus cost of capital over cost of capital multiplied by 100 over 1. Anything you are going to calculate in your sensitivity margin must be expressed in percentage. Okay? Then number 3, sensitivity margin to project life. So it's computed as project life minus break-even point of project life divided by project life multiplied by 100 over 1. So that's the formula for calculating sensitivity margin. Now, you notice that in this sensitivity margin to project life, we have break-even point of project life. What that simply means is that whenever you want to compute sensitivity margin of project life, you need to first of all go ahead and compute break-even point of project life. Then, how do you calculate break-even point of project life? Let me see if I can get a space here. Okay, let me manage this space. So, calculating, let me show you. Calculating break-even point of project life. Okay, so whenever you want to compute break-even point of project life, there are 3 procedures. The first procedure is to reduce the life of the project by 1. Reduce the useful life of the project. Okay, life of the project by 1. That's the first step. Then step 2, calculate NPV of the reduced life. Okay. Then step 3, calculate break-even point of project life. Okay. Using the formula below. Using the formula below. So in this case, whenever you want to calculate break-even point of project life, so it will be, let me see, break-even point of project life will then be equal to normal life. No, this place cannot accommodate it. Let me use the break-even point of project life equal to reduced life plus NPV of reduced life over NPV of reduced life plus NPV of normal life. Let me push it to the front. Okay. All of this multiplied by normal life minus reduced life. All right, just like you want to calculate break-even point. Sorry, you want to calculate internal rate of return. So that is the formula for calculating break-even point of project life. That's that. So like I said, notes, let me put it there. Notes, RL equal to normal life, the normal useful life of the project. NL, sorry, NL is normal life. NL is normal life. This is reduced life. RL is the reduced life. So that's that. Okay. At this point, now one more thing you need to know. When calculating sensitivity margin of sales volume, the PV of contribution should be used as the denominator. All right. I repeat, when calculating sensitivity margin of sales volume, the present value of contribution should be used as the denominator. All right. So that is that. Next, what else? Now, whenever you compute your sensitivity margin, you have to interpret your result. It's not sufficient for you to just calculate sensitivity margin. You have to interpret your results. And there are two different ways you can interpret your results. Let me see if I can get a space up there. Okay, let's come down here. Now, whenever you want to interpret your results, like I said, there are two different ways. Interpretation. All right. For variables, such as sales volume, sales value, contribution, savings, project life, then it should be interpreted as the variable. This is the interpretation. You then say the variable. The variable in this case, it could be sales value, it could be sales volume, it could be contribution. The variable should not be allowed to fall below the percentage attained. So whatever percentage you have calculated, maybe 2.5%, maybe 5%. So it should not be allowed to fall below the percentage attained. If not, the project will not be viable. So that's the interpretation for all those variables are listed there. Then also, no space. For variables such as, where did I write down those ones? Okay, let me say this is A, then B, for variables such as initial outlay, variable cost, fixed cost, okay, cost of capital, and cost of capital. Then interpretation. What are you supposed to say? You then say the variable should not fall, should not increase beyond the percentage attained. Otherwise, the projects will become unviable. So that's the interpretation for all those variables that are listed up there. All right. So this is how to interpret sensitivity margin computed. Anytime you have calculated variables such as sales value, sales volume, contribution, and all, project life, and all of that, So the interpretation is that the percentage you have calculated should not be allowed, the variable should not be allowed to fall below the percentage you have computed. If not, the project will not be viable. If you want to talk about if the variable is initial outlay, cost of capital, all right, variable cost or fixed cost, then the interpretation should be that the variable should not be allowed to increase beyond the percentage calculated. Otherwise, the project will become unviable. So whatever percentage you have achieved will represent the tolerable extent to which NPV can accommodate any change in the variable. All right, so we still have about 15 minutes. Let's use it to solve illustration so that in our next class, we go straight to simulation, then we do decision tree. So that will be that for risk and uncertainty. So let's have illustration, please, quickly. Yes. Illustration number 3. Let's have illustration number 3. Who will help us? Some of you have disappeared. So who will help us to read illustration number 3, please?
Okay,
Quickly.
Tinapa PLC
Thank
has
you.
sought your advice as a financial consultant on its investment proposal. It plans to diversify into the production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plant and equipment will cost 4.8 million naira. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this level, activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, is estimated at 360,000, while variable cost is planned at 18 naira per unit. The market research carried out setting the selling price at 24 naira per unit. The company's cost of capital is 70 naira. You are required to advise whether the investment proposal is worthwhile. Calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal.
So thank you. So you will notice that in this requirement number B, examiner did not tell you to calculate sensitivity margin, all right? But it's implied in the question. Once you can see, once you are given variables, you are given the listed variables, then you should know that this is sensitivity margin. You can see here that you are told to calculate the tolerable level, and you know that sensitivity margin measures the tolerable extent to which a project NPV can accommodate any change in variables. All right, so you have been told this, so you need nobody to tell you that you are going to use sensitivity margin to adjust for the risk inherent in this particular project. So without wasting more time, I want to calculate NPV because examiner asks you to advise whether the investment proposal is worthwhile, which means that you are supposed to calculate NPV. Let me stop sharing this and move to the working notes. So I will remove this. Now, solution to illustration. I think that's illustration about what? Number 6 or
3.
number 3. Yes, thank you. Illustration number 3. Page that's page 79.
Yeah, correct.
Page 79. Okay. So the name of the company is Tinapa Limited. Number A requirement, you have to calculate NPV. I would then say calculating net present value. So quickly, create a column for year, description of items, cash flow, Discount factor. What's the cost of capital given? 17%. Then we have the present value. Year 0. The useful life of the project is 10 years. So year 1 to 10. Here is initial investments. In the question, you are given selling price and variable cost. Therefore, we are going to calculate annual contribution. Then you are also given production cost. Production cost to be 360,000. Initial investment is 4,800,000. All right. So at this point, let's go and calculate annual contribution. This will be for the NPV, then sensitivity margin, then let me extend beyond that for our workings. Okay. So working number 1, I want to calculate contribution. So contribution is equal to selling price minus variable cost per unit. According to the question, contribution is 24 naira. Variable cost is how much? Variable cost per unit is what? 18 naira. Okay, 18 naira minus 18. So contribution is 6 naira per unit. Therefore, total contribution will then be equal to the number of units, 240,000 units, multiplied by contribution per unit of 6 naira. This will give us 1,440,000. So that's our annual contribution. Let's go and post. So here will be 1,440. Our figures are in thousands. Okay. So multiply by 1. Somebody should give me an annuity factor of year 1 to 10 at 17%.
4.659.
4.659. 4.659. Let's multiply that with the cash flow.
6709.
6709. Okay. Then 1677. Final answer 232. That's NPV. So examiner is asking you to advise whether the investment proposal is financially worthwhile. All right, so I would then say the investments proposal is financially worthwhile, considering the positive NPV of 232,000 naira. So that's number A. Then number B, you have to calculate sensitivity margin. Okay, sensitivity margin. Number B1, sensitivity margin, that is SM. So sensitivity margin of, what's the first variable given to us?
Initial investment cost.
Initial investment of initial investment, which should be NPV divided by the present value of initial investment multiplied by 100 over 1. NPV is 232. PV of initial investment is 4,800 multiplied by 100 over 1. Give it to me. What do you have there?
4.83.
4.8%. Okay, 4.8%. So you need to interpret your results. So I would then say the initial investments, the initial investments should not increase beyond 4.8%. If not, the investment proposal, the investments proposal will not be viable. That's interpretation. I'm not going to write interpretation for all of them. So I'll just give you samples. But in your own notes, you have to write for all so that you don't think that's how it should be. So you do interpretation for all the variables. So number 2, what's the next variable?
Production cost.
So sensitivity margin of production cost, which is NPV of 232 divided by the PV of production cost of 1677 multiplied by 100 over 1. Give it to me. What do you have?
13.8%.
13.8%, which means that the production cost should not be allowed to increase beyond 13.8%. If not, the project will not be viable. Number 3 is what?
Sales price.
Sensitivity margin of sales price. We don't have sales price. We don't have present value of sales price. So this will be NPV of 232 divided by the present value of sales price. So let's go and do working for that. We don't have present value of sales price. Working number 2, PV of sales price. So first thing first, you need to get the sales value. Sales value is 240,000 units multiplied by selling price of 24 naira. This will give us
760,000.
Then we need to get the present value of sales, which is equal to total sales of 5,760,000 multiplied by annuity factor of 4.659. Give it to me.
2683
Pardon?
584.
26 what?
26835 840.
840. That's the total, that's the PV of sales. Therefore, I will then go back there. Of course, our figures are in thousands. That would be 26836. 26836 divided by 26836 multiplied by 100 over 1. Give it to me. What do you have? That will give you 0.9%. Okay, so let me interpret this one. I would then say the sales price should not fall below 0.9%. Otherwise, the investment proposal will not be viable. So the interpretation of this is that the sales price can reduce up to 0.9%. Anything below this 0.9%, the NPV will be negative. This 0.9%, if you reduce the selling price of 24 naira by 0.9%, it will make the project to break even. So what that means is that at any point below this 0.9%, the project will become, the NPV will become negative. Then number 4 is what?
Sales volume.
Sensitivity margin of sales volume. So I told you, whenever you want to calculate sensitivity margin of sales volume, you have to use the present value of contribution as the denominator. Therefore, NPV of 232 divided by PV of contribution, which is 6709, multiplied by 100 over 1. Give it to me.
3.4, 3.5.
3.5%. So this one has the same interpretation as the sales price. That is, the sales volume should not fall below 3.5%. If not, the project will not be viable. Number 5 is what?
Variable cost.
Variable cost. Sensitivity margin of variable cost, which is equal to NPV of 232 divided by the present value of variable cost. We don't have present value of variable cost, therefore we need to go and work it out. Working number 3, PV of variable cost. Okay, so first thing first, you calculate variable cost, which is 240,000 units multiplied by variable cost per unit of 18 naira, which is 4,760,000, right? Am I correct?
No, 4,320,000.
Sorry, 320,000. Thank you. 320,000. Then we calculate PV of variable cost, which is total variable cost of 4,320,000 multiplied by annuity factor of 4.659. Give it to me. That's 20 million.
12880.
12880.
6,880.
Again, figures are in thousands, so this would be 20,127. So let's go up there. 20,127. So divided by 20,127 multiplied by 100 over 1. What you have? That's 1.2%, I think. Please confirm.
Yes, correct.
All right then. So this one, you have the same interpretation as the initial outlay. Then number 6 is what?
Product life.
So sensitivity margin of product life, which is calculated as project's life minus break-even point of project life divided by project life multiplied by 100 over 1. So in this case, we don't know the break-even point of project life. We need to go and work it out. So this will be equal to, the project life is 10 years minus break-even point of the project life. Let's calculate it. Working number 4. Break-even points of project life. Product life. Okay. So the first thing you need to do is to reduce the life of the project by 1. The life of this project is 10 years. So 1 minus 10, that's 9. Then you calculate the NPV of the reduced life. Then you calculate the break-even point of the product life. So let's calculate NPV of the reduced life now. Yes. Items. Cash flow. Discount factor at 17%. Then we have the present value. Year 0, 1 to 9, 1 to 9. Give me an annuity factor of year 1 to 9 at 70%. Initial investments, 4,800,000. Contribution, 1,440. Then production cost, 360. So what do you have?
4.45.
4.451, right?
Yeah, 4.451.
451. So multiply. 4.451 multiplied by 1440.
6409.
6409. Then 360 multiplied by 4.451. 1602.
1602.36.
So the difference is 7. That's the NPV of the reduced life. Now, since you have calculated the NPV of the reduced life, then you then calculate the break-even points. Break-even points of project life, which is equal to reduced life plus NPV of the reduced life over NPV of reduced life plus NPV of the normal life multiplied by normal life minus reduced life. Okay. Now, the reduced life is 9 years. NPV of the reduced life is 7 divided by 7. NPV of normal life is 232. Normal life is 10 years minus reduced life of 9 years. Put it in the brackets, then plus 9. This will give you 9.03 years. That's the break-even point of the project life. I can then proceed to calculating the sensitivity margin of the product life, 9.03 divided by 10 years multiplied by 100 over 1. Fine answer, give it to me. That will give you 9.7, right? 9.7%. Okay. Then finally,
Yeah, 9.7.
number 7, sensitivity margin of cost of capital, which is calculated as internal rate of return minus cost of capital over cost of capital multiplied by 100 over 1. So as you can see from this formula, we have internal rate of return. So what that means is that we need to go and calculate internal rate of return first. So I will then come here. I will say calculating internal rate of return. Okay. So let's assume 20%. The cost of capital given in the equation is 17%, which we use to compute NPV, and we got 232 NPV positive. So let's assume 20%. So if this 20% give us a negative NPV, then we assume 70% as the second discount rate. So create a column, description of items, cash flow, discount factor at 20%, then PV, year 0, 1 to 10, 1 to 10. Initial investments, contribution, production cost, 4,800, 1,440, 360. Somebody should give me an annuity factor of year 1 to 10 at 20%. Yes, we're almost there. That's 4.192. Am I correct? Please confirm. So multiply. Women, are you still there?
Yes, I'm here.
Give me the value.
Okay. 6036.
6036. Okay.
1509.
1509. So what's the difference? That will be 2.
73.
273. Negative. So we assume 20%, we got a negative NPV. So we then assume 17%, we got a positive NPV of 232. So in that case, I can then proceed to calculate the internal rate of return. Therefore, IRR will be computed as A plus NPV of A over NPV of A plus NPV of B, all multiplied by higher discount rates minus lower discount rates. Okay, IRR is then equal to A is the lower discount rate, which is 17%, plus NPV of the lower discount rate is 232 divided by 232 plus NPV of the higher, which is 273, multiplied by higher discount rate of 20 minus lower discount rate of 17. Give it to me. What do you have? Final answer. IRR is equal to 18 points.
4.
No, 18.38, right?
Yeah, 38.
All right then. So I can then go back. I would then say 18.38 minus 17 divided by 17 multiplied by 100 over 1. Final answer. That's
8.4.
8.4. 8.1%. So which means that the cost of capital should not increase beyond 8.1%. If not, the project will not be viable. Again, for the product life too, the product life should not reduce below 9.7%. Otherwise, the project will become unviable. So this is how to calculate sensitivity margin of variables. So take your time, go through it, and then please, whatever you are learning now, between now and when the diet will close, please, you don't need to come back to it again. Just take your time to understand it fully so that you are not coming back to it again. Whatever you are learning now is part of your revision. All right. So your focus should be on those ones where you are really struggling. All right. So that will be that for today. By the grace of God, we are meeting again next week. We are meeting on Wednesday in the next few days. So to continue. So in our next class, we are going for simulation. After simulation, we do decision tree. Then I will introduce you to business valuation. At least I should be able to explain all the underlying concepts of business valuation on Wednesday by the grace of God. So thank you guys. Let me know first thing first if you have any question for me before I close the class. So if there's no question, and that will be that for today. So thank you. I will see you on Wednesday by the grace of God. Good night, everyone.
My eyes are closing.
I can imagine. Me too. You won't believe it. This is my fourth class. This is my fourth class today.
Wow.
I had 3 hours in a solo for at professional level, another 3 hours at skills level. When I came back in the afternoon, 4:30, I had skills level, performance management. Now I've done additional hours, about 2 hours plus with you. So you can see the entire day has been hectic for me. But again, I can't complain.
Thank you.